Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. As we try to get into the mindset for a discussion on global bond markets, think of a river with cross currents, currents interrupting one another, reversing in swirls and backing up water in short bursts as it all ultimately flows towards lower bodies of water in one big direction. According to our next guest, cross currents within the global bond markets are providing more opportunities than ever. Geographic displays of differing interest rate policies, a depreciating US dollar, a new narrative around safe havens are all creating fertile ground for global bond portfolios. Joining us here from London is Fidelity Fixed Income Portfolio Manager, Michael Foggin. Welcome, Mike. It's great to see you. Thanks for spending your time here with us.
Well, thank you very much, and thank you for having us.
Delighted to have you join us here today. I wonder if we can begin. We're going to dig into what your fund does ultimately and sort of the parameters around it in just a second. But I wonder if you can take us through, as we approach various dates throughout the summer, really what the trade story globally has meant for bond markets. Because in April, it required the Treasury Secretary in the US actually to step in and sort of, oh, the bond market's not doing so well on that front. Just tell us about trade and the bond market and what you are watching for these days.
Absolutely, yes. Well, as you say, in April, there was a huge, there was a huge announcement of tariffs across the world, and the market reacted with a lot of uncertainty, a lot of movement, yields higher, yields lower, spreads wider, and we've mostly retraced those movements. We've seen bond yields back to within 10, 20 basis points of where they were at the start of April. We've seen credit spreads retrace nearly all of those movements. We are rapidly approaching the 9th of July, the date at which that pause in tariffs will be lifted. And the market is pretty sanguine and pretty hopeful that there will either be some form of deals will be done. There's been one done with the UK already. There's been a lot of positive sentiments with regard to other regions. That either another pause will be announced or that some outline of deals will be enough that we won't move back to this sort of worst case scenario. So it certainly has generated, as you mentioned in your introduction, these sort of counteracting pressures that the market is trying to deal with. And it's really not just around trade, it's around inflation, it's around growth, it's around demand and supply. We can certainly feel that as tariffs are added to a global economy, that's like throwing sand into the wheels. Like that has to be slowing the economy somehow, and
That's
potentially
great.
putting upward pressure on prices. At the same time, inflation has been generally trending downward. It's felt sticky and persistent in some places, but there's been that general trend, which has allowed central banks to at least get some rate cuts into the market. And so that sort of potential slowing of the economy has been pushed back on by large fiscal spends from a number of governments. Notably Germany announcing $500 billion or €500 billion even of infrastructure spend. Just last week, NATO agreeing to spend that's about a 5% of GDP on defense. These are all additional spends that are going into the market to support that potential slowing growth. And as I've mentioned, that's just another cross currency because, again, if government's going to spend that amount of money, they have to raise that amount of money. So that's more bonds that need to be issued to the market. And so more supply coming to the market. And as we know, what are the two things that counteract? Well, supply and demand, right? And so supply is coming. So what's the demand? Well, it's been there. We definitely have the demographic, that aging population. And what we've really seen is the demand for fixed income because
Interesting.
the total return that you can see or the expected return in various scenarios is pretty attractive. And so what I've sort of been through a number of different opposing forces there, and the market seemed to have come up with the idea that, okay, the return's not bad. So we don't know what's going to happen. We don't have a crystal ball. But if you can offer me mid-single digit to high single digit returns, depending on the asset class or the outcome, that's pretty good. And so demand for fixed income has remained pretty strong in this period where you can make arguments for higher and lower rates. And so it sort of feels like we've found an uncomfortable equilibrium.
That's really, really interesting and a place to be. So let's go to the fund itself that you manage here. It's global in nature and it takes advantage of a number of things that you just talked about. There's supply and demand in differing countries being different, interest rate differential. Why global now? This has obviously been a theme of this year, going global for more US focused investors, making sure they are outside different borders. It also is for the bond market.
So unsurprisingly, as a manager of a global bond fund, I always argue that global diversification is a positive thing, and you should take it. Uh, it is, as people have said in the past, the only free lunch when it comes to investing. Diversifying your portfolio gives you the sort of uh, risk to return profile that people are looking for. Now, given everything we've just spoken about, uncertainties, unless you have a really strong view on a bond market or an economy or a central bank, it just feels like now is the time for smaller exposures, more diversified exposures, um, taking that positive return you can get from that diversified opportunity set, as opposed to being really keyed into one bond market, one yield curve, one central bank, one currency. You may well be right. That's great. But it feels to us that this is a time when um, a smoother return is probably more required. And so, in these times of uncertainty, if you can get a good, solid return from diversified source, that seems like a better place to go.
And the times of uncertainty, sometimes we get walloped across the globe because something large happens in the US, and then, of course, there's everyone else catches a cold and so on. But you would be in particular markets that I guess would have their own idiosyncratic reasons for dodging higher or selling off. Tell us a bit about those moments slash opportunities.
I mean, there are, you know, there is correlation between global bond markets, so you can see that they generally trend in the same directions because many themes are global by nature. Um, However, there definitely is opposing forces when you think about where we are in economic cycles, where we are in rate cycles, and um, how reactive central banks can be to that. So there has been winners and losers. When you compare the Japanese bond market, the long end has sold off quite significantly. The US market has actually been the better performer year to date, which doesn't feel like it has been, but it has been.
Yeah.
Uh, there's certainly, opportunities. We think in the UK, where the Bank of England perhaps has the opportunity to cut more than other central banks, perhaps there may be more weakness in the labour market there than is currently expected. And so there's opportunities, there's opportunities to nuance between those global bond markets, but generally, I think that diversification is what you should be looking for. I would be, it would be unlikely to think that your best fit is just one bond market.
What types of catalysts might you wait for? So you mentioned the Bank of England. I mean, it strikes that if they're cutting for reasons of the labor market, they're not sort of cutting for the good reasons. They're cutting potentially to stave off other things. But what other kinds of upsets essentially have you looked at, even historically?
So it is generally would be the value would be the driver of us wanting to add more risk to a portfolio. So that generally comes in widening credit spreads, and widening credit spreads generally are, well, there's two drivers: either a technical factor, which would be outflows out of fixed income markets generally, causing people to sell fixed income, causing credit spreads to widen. The other would be fears of recession. Fears of recession, credit markets asymmetrically move wider. And so often the opportunity set is when the market is more fearful of a recession than we are. And that would be an opportunity where we think, well, there's enough priced in now that we know the underlying companies, we know um, their weaknesses, and we feel like you're getting paid enough to own them. So at the moment, credit spreads have very little priced into them. And so we are as low in credit risk as we can be.
Okay.
Um, However, as investors into the asset class, uh, it feels like the all-in yield is pretty good. When we sort of think about scenarios of a base case being perhaps inflation trims down a little bit, perhaps central banks cut a little bit more, perhaps yield curves steepen a little bit more, and credit spreads just trend tighter because demand outstrips supply. Seems like a decent base case. You're looking at pretty good return. A next scenario would be, well, actually, maybe these trade tensions cause, an economic slowdown, even stroke recession in some environments. What will happen then? Well, credit spreads will sell off, but yields will value more. And so the total return again for investors is not bad in that scenario. So we sort of look at our sort of main scenarios and think it's not a bad time to be invested in fixed income. And certainly taking that carry of credit is pretty attractive.
Take us into the currencies. We've heard about bond vigilantes going around the world and looking for opportunities. Now there's sort of this discussion of currencies really um, being very different classes in certain cases. And I mean, what does it mean to you to own assets in those? Um, I guess one thing we would ask on that is just, is the US dollar the safe haven that it once was? And if not, how do you deal with that one way or the
Right.
other? Is it just
Well,
further diversification?
I'm unfortunately not going to give you a great answer to this because I'm a strong advocate of having your fixed income hedged back to your base currency. So if you
Interesting.
are a US investor, I think you should have your fixed income hedged back to US dollars. If you're a Canadian investor, you should have it hedged back to your home currency. And the reason that I think about that is, I'm based in the UK.
Yeah.
The majority of my expenditure is in sterling. I have very little expenditure in euros or dollars or Canadian or yen. Why do I need that in my investment outlook, right? So I tend to have most of the funds hedged back to the base currency of the investor.
Interesting.
That gives you the diversification of other markets, of other economies, but not the volatility of the FX market. And I think the volatility of the FX market can often dominate a fixed income market. And so you will be looking at sometimes multiple of the volatility coming from the FX that's coming from the rates market. And so I'd rather just take that rates market, isolate that, and hedge it back to your base currency. Now, when we think about whether the US can and will lose its reserve currency, lose its
Status.
status as a reserve currency. It's an interesting conversation to have. It's an interesting thought process, but it seems to me there isn't an obvious alternative yet. And so I am a little less, I understand the arguments. I'm open to the arguments. I'm glad people are having the discussion. I just don't see an obvious move away from the US dollar yet.
Yeah, really interesting. With global markets, you mentioned actually at the very beginning that to an extent, global bond markets, including US markets, and the whole discussion of what kind of spending will need to go on fiscally, which they will
Mhm.
go to the bond markets to do, house markets actually quite sanguine, which um I don't know, I don't want to be doomsday, but do you worry about that at all? That this is all just being accepted relatively well?
I mean, absolutely. We definitely, when Germany announced its last fiscal plan, there was a decent move wider in bunds being German government bonds,
Yeah.
maybe 40 basis points wider quite quickly, and it felt quite violent. It's retraced all of that and more. And so you sort of think the market has actually found, the demand for fixed income now is has been growing and is strong enough now because of the potential returns that it feels like those that increased issuance can be taken down by the market. The demand will be there. So as I mentioned, it's an uncomfortable equilibrium where it feels like yes, there can be pressures, upward pressures, but there's a limit to how high they can go. And the market, investors are saying, well, I'm okay with the return I'm going to get now. And if you think it might be a little bit higher in the future, maybe I'll just buy more. Or it certainly feels from investors we speak to that that's the attitude, as opposed to um, these markets will become unhinged and head towards some much higher levels. It feels like yes, there could be upward pressure, but not enough to impact or not enough to make the returns negative. And so investors feel like they need to continue to own fixed income, which I've got a lot of sympathy for that point of view.
I want to get to the point of reflecting on essentially why taking a look at global bond
Yeah.
a fund now, but I feel like we just have to go a little bit back into history
Mhm.
and take a look at what it meant for so long. There was a repression in markets. Rates were unusually low for a very, very long time, to the extent it was, almost a generation long, 20 years long. And we got really quite used to all of that.
Yeah.
COVID came and everything changed, and we went in and out of rates being high and then lower.
Mm.
Uh, Price discovery was something that, it was a normalization. Those are sort of terms that we kept hearing. We need to kind of get through those to get out of that 0% environment. Are we in very fully price discovery mode, normalization? Can we march forth from here and not really think about what that environment meant for quite a long time? Is it a new time for bonds because price discovery is front and center and things are
Yeah.
normalized?
Yeah. So I don't think we have the repression that we had in those periods. I do feel that markets are free to move around, and we are seeing that. We do see the volatility in bond markets, and you know investors prepared to buy and sell, and therefore it does feel like the market is appropriately priced. I don't feel like we are going to head back to those levels of QE and zero rates again. But the market knows that it's in the toolbox. If the market needs to, if the central banks need to, they can cut progressively from here. Now the environment's not there to do that, but once we've opened that toolbox, it remains there. So I feel like the market is digesting all of these flows and pressures and different views. And the price that we found for bonds is reflecting that information.
It's really interesting. It's a different time.
Mm.
With that said, you all bond traders will wait for the right moment. Equity traders as well. People who are taking a look at managing things. You have to have some patience. Um, what is an example of what the not enough patience looks like, right, in these markets that we've just been through for the last 6 months? Because people have been jumpy.
Mm. Yeah. So yeah, you are absolutely right, and you've touched on the two most important things I would say in the current environment. That's diversification and patience, right? And we talked about diversification and why it's a good opportunity to have a broader opportunity set, uh, both both as an investor into funds, look to the funds with the most opportunity set, as an investor myself, being able to look around the world for an opportunity or where there is an opportunity. And then patience is, we would only look to invest when and where there's an opportunity. If there's no opportunity, you're currently being paid quite handsomely to be very defensive. Now, that's not always the case. Often it feels like when rates, as you mentioned, were so low, um, you felt like you had to do something to try and to make some return. Whereas now, okay, returns are pretty good. I would suggest you wait for an opportunity. Um, what would that opportunity look like? Well, we hope it would be a credit spread widening event that we can get comfortable with. That you can say, okay, there's enough priced in now. Even if growth does fall, it doesn't feel like it's going to be a deep recession. There's enough. I'm being paid enough at these sort of levels to take that risk on. Or there's some fears of demand falling away in the fixed income market, and so credit spreads move wider, and then we would look around and think, well, I think the demand is still there. Demographically, it's still there, and so that's an opportunity to step back in the market. And so what can happen in these periods, because we are potentially looking at a period of where volatility will fall from here. July tends to be a good period for credit markets going into a summer, although it feels like summer's already here.
That It's
We
been
could be a
quite
period
warm in
where
the UK, hasn't it?
very warm. Oh, it's very, very
Good.
warm,
Good.
which is great. We should be grateful when it comes. But yeah, people can feel like, oh well, this is it. Credit spreads will never go wider again. Let's get really overweight, and let's make a return like that. And we can be a little bit more sanguine and say, well, actually, we're going to wait and see where there's pockets of opportunity, whether that's European utilities or European banks or US energy companies or UK water companies, or where that period of that opportunity arises, that's when we look to increase risk. But until we see that, I think being defensively positioned makes sense in this environment. It's not the most exciting thing to say to you at the moment, but it is we mentioned previously the volatility of April. I think there were 2 days when the market was cheap. There was 2 days.
Wow.
So if you manage to do anything those 2 days, that's great. We got a little bit of risk added to the portfolio, but not a great deal. You have to be quick, because often everyone else can see the same thing that you can see, but you have to be nimble, and you have to be have the sort of broad team to be able to deploy risk quickly.
Fantastic. And Fidelity has just that global team to do such a thing. You started mentioning asset classes or types of
Yeah,
investments that could be of interest. Uh,
yeah,
Big discussion, private, public, maybe all of it's changing a bit with these fiscal impulses
mhm,
for defense, for all kinds of different fiscal spending that we're seeing on your side of the Atlantic. But it's an interesting discussion about what types of projects, companies will be of interest. Tell us a little bit about how you structure the fund. I mean, do you have a
yeah.
lot of exposure to government typically? Has any of that changed? Do you expect that to become a greater portion of it? Take us through how you're positioned now and maybe how that
Yeah.
varies.
Yeah, absolutely. So we are very much in the public side of the debt market. We probably have the highest exposure to government debt that we've had in the portfolios, um, and that's more to do with wanting the liquidity and ability to add to credit markets when the opportunity arises. And so we are looking to build that liquid part of the portfolio for exactly that. We don't want to be a situation where you have a short window of opportunity and you're trying to move parts of your portfolio around to make space to add the risk. You want to be able to add the risk quite quickly. So in that grounds, we are defensively positioned in that we have more liquidity in the portfolios than we would normally. But having said that, there are parts of the markets which are cheaper. I wouldn't say any parts of the market are cheap, but there are definitely parts which have more value. So by being, more underweight US investment grade credit and being more overweight European investment credit, we're able to generate a carry advantage without, we believe, taking on a lot of beta risk. So we are looking for opportunities where we think there is more cheapness in some parts of the market, and versus richer parts of the market, and by underweighting and overweighting, we can still remain neutral to the overall direction of the market while generating a positive return. So we sort of have an overall defensive position, but underlying there are some opportunities that we think we can take advantage of.
So it sounds like are you quite close to the benchmark, depending on, I mean, I
Yeah,
guess
yeah,
on
yeah.
any given
At an
year?
overall level, there are different ways of judging your risk, but one of them would be a tracking error, and our tracking error is historically low. Our credit beta is historically low, but we still do have a carry advantage to the benchmark, but again, low in historical terms. So, we think the total return for investors is pretty good. The opportunity to outperform in a small way is there, but we're waiting for that, I don't know what the right analogy is, that fat pitch, that,
Yeah.
that opportunity, which we will then, deploy more risk into the market.
To what extent have you got duration? How is duration? There's lots of questions to ask about duration. We could spend a whole half hour on that. But tell us a little bit about where you are. Are you in the belly of the curve? What do you like?
So we definitely have had steepness across the curve, but that's mostly been by being overweight the belly and then underweight the long end, and that's the positioning we still keep. Our duration is pretty neutral in euros, because, as we've discussed, there are these potentials for this large fiscal flow, potential for upward pressures, but still a yield curve which can steepen and make, as the central bank keeps the cut. The UK is a bond market where we think there is potential for the central bank to cut more, and therefore it's probably a bond market with slightly overweight, but again, mostly based on the belly, underweight the long end. And in the US, we do have a small overweight to US Treasuries, They've done pretty well recently, sort of heading back to that 4.25 sort of level. But again, I think you can see the market has started to price in more rate cuts, and so you could see a little bit more steepening in the front end there. So these are not huge, these are not huge directional bets in the portfolios, but we think there are opportunities within rates markets to small outperform.
Okay, that's fascinating. Further into the asset mix, just take us, as you mentioned, government debt for sure, and actually some on the duration there. What about corporate debt? How does that fit, even the high yield market?
Yeah. So that is a lot of the time the sort of the driver of alpha in the funds. We have big teams of research analysts looking at these names, and we do really feel like we know globally, these companies really very well, and really have a good handle on when there's value and when this is the right time to add. We are about as low on corporate debt as we've really been in these funds. Now, we think the fundamentals are in pretty good shape. So, corporates, industrials, utilities seem to be in a really good shape balance sheet wise. They've been through the turmoil of COVID. They've been through the rate hiking cycle 22. They've sort of driven through those scenarios, and that's kept them pretty defensively positioned. We would say overall, M&A has been pretty low. So we think they're in a pretty good spot. The other side of the market, the financial side, higher rates has been pretty good for earnings. And again, there hasn't been that sort of animal spirits in the markets to drive them to take on too much risk within their portfolio. So again, we think banks are in a pretty good spot. So overall, the health of the fundamentals is pretty good. But spreads entirely take that into account. I think US credit's in its second or third percentile. There's not a lot more room for it to rally. Europe's got a little bit more room to rally, but overall, we think the fundamentals are strong. The valuation isn't great, and we're looking for an opportunity to ramp that back up again.
Okay, we need a catalyst, which usually means bad news, actually, doesn't it?
We need something bad to happen that's not too bad.
That's right. Exactly. Where does this belong? Who is this for? You've mentioned it a couple of different times. I won't ask you necessarily to opine on the 60-40, but do bonds still do what bonds are meant to do? I think is an appropriate one.
Bonds do more of what they're supposed to do than they have done for a long time. And so, whether you're 60-40 or however you feel the right mix is, if you have fixed income in your portfolio, I think diversifying some of that into a global makes a lot of sense. And so I would say anyone who has a fixed income allocation in their portfolio should consider which global flavor of fixed income they should have, rather than just having exposure to one specific yield curve, one specific central bank. So, it's broad. It's a broad market, and this should be space for most investors.
Do you have a team around the world? Just as we close out here.
Yeah. So working particularly on global credit, we have 3 portfolio managers based in London, 1 based in the US, and between us we look at the opportunities. But as you mentioned before, it's a deep bench of investors in fixed income. We then draw on close to 250 fixed income investment professionals that we get to draw on. So while it's London and US based, we are pulling on this resources from around the world to understand both the macro risks around the world, but also the bottom up fundamentals of the different companies you want to invest in. So there's a lot of people helping drive these portfolios.
Fantastic. Mike, you're leaving us wanting to know more, and I think that's always a good place to stop, actually. I appreciate your time and taking us through the fund itself and how you approach it.
Great. Well, thank you for the time, and I look forward to speaking to you again.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.